What's up everyone, it's Kadi with Money Investing. In this video, we are going to be talking about a report released by FactSet today, going over the earnings per share on the S&P 500 companies and how the confidence level is absolutely rock bottom among companies issuing guidance for the first quarter 2023 earnings, which the earnings season is literally right around the corner. So hope you guys are doing great. If you guys enjoyed this video, find it helpful, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. The link to our Discord and Patreon is going to be down below. If you're interested in joining us, I think we've got like 2 spots left. And you can also access all the buy and sell alerts, options alerts, trade ideas, as well as all the private member videos and benefits as well. And we've also got the fundamental and technical analysis courses currently on sale. One of the biggest sales of the year, 60% off. And the coupon code is going to be Easter for the fundamental and technical analysis course bundle. That's valid for lifetime, so you get lifetime access to all the courses and all the educational lectures and all the additional content that's going to be added over time. And that's over 30 plus hours of content with over 80 plus lectures available. So 60% off, link down below, coupon code Easter. So first things first that I wanted to break down in this video was this idea that the credit crunch is actually happening. So after the Silicon Valley Bank's collapse, we pretty much saw a lot of banks, other banks also fail, and as a result, liquidity dry out in the banking sector, which is one of the reasons why the Federal Reserve jumped in with the Bank Term Funding Program and allowing for all these banks to kind of swap out their assets for additional liquidity. And as a result, the Federal Reserve is actually holding on to $1 trillion in losses. That's the biggest loss we've ever seen for the Federal Reserve because a lot of their assets are actually underwater. There was another analysis or a survey done of 71 banks in the Dallas Federal Reserve Bank District completed between March 21st and 29th after the March 10th collapse of Silicon Valley Bank. And Torsten Sloak, chief economist at Apollo Global, says, and I quote, that the survey shows us a dramatic reversal in loan volumes. And this right here is the significant decrease in the loan volumes and as a result, a huge credit crunch. Now, this is a problem because if people are obviously not borrowing at the same rate and the credit is, very, very hard to come by, there are liquidity issues, what happens, right? People don't spend enough, companies don't invest enough, and as a result, earnings struggle. Something that we have talked about. Everything that you discuss about the market, whether it's interest rates, inflation, economy, unemployment, everything, it all just boils down to one thing. That's earnings. Earnings. That's really what matters at the end of the day, because everything can be trickled down or everything can be, focused on earnings. How is this going to affect earnings? How is that going to affect earnings? All of it comes down to earnings. And unfortunately, right now, we're in a situation where a highest number of S&P 500 companies are issuing negative EPS guidance since third quarter 2019. So this actually came out today. As of today, 106 S&P 500 companies have issued EPS guidance for the first quarter, and the number is above 5-year average of 97 and 10-year average of 98. In other words, more companies have issued the guidance, and of those 106 companies, 78 companies have issued a negative EPS guidance, and 28 have issued a positive guidance. So if you do the math, 70 divided by 106, we're looking at about 73.5%, almost 74% of companies issuing a negative guidance for the first quarter 2023. The number of companies issuing negative guidance is above the 5-year average of 57, a 10-year average of 65, and the number of companies issuing a positive EPS guidance is below the 5-year average of 39 and the 10-year average of 33. So again, confidence is not that high going into this earnings season. Expectations are, among at least companies, it's not that high. Analysts are still high on something, I feel like, because their expectations are still high right now because they are expecting pretty good numbers to come in from earnings standpoint. And you can see that this number has been increasing since the second quarter of 2020. We did see a bit of a pullback in the first and second quarter of 2022, and now we are once again at the same level from back in third quarter 2019. If this number eclipses over 85, then I think we'll have to go back to maybe 2007, 2008, around that time when expectations were even further lower with respect to guidances for the earnings per share. So right now you can see that S&P 500 negative EPS guidance, it has been growing from 23 to over 78. And as this number continues to push higher, that's from a company's management standpoint, it is less confidence in the earnings moving forward. This right here is going to be the sector level negative EPS guidance, and technologies coming in ahead with over 27 companies issuing a negative EPS guidance for first quarter 2023, and that's the 5-year average. You can see that it's well below 20, so we're having an above average in IT. Industrials over 16 versus 6.6. Consumer discretionary is the only one that is still below its 5-year average. Healthcare also is below its 5-year average, and real estate is below its 5-year average. But staples, materials, we got comm services, financials, utilities, all of them issuing negative guidance, EPS guidance for the upcoming quarter, which is the first quarter 23, which the earnings season are going to start very soon here with respect to their 5-year average. This right here is just the opposite chart showing you the positive EPS guidance, and it's been on a consistent decline. And you can see that we are coming back to the same levels as we were from back in first quarter of 2020. And the lowest we actually got down to was around second quarter of 2020. It's 24. And right now we're sitting at 28. So we still are slightly higher, but if you dip below 24 companies on a more aggregate basis, then it's possible that we start to see, confidence weakening out even more among companies. This is going to be which sectors are providing us with a positive EPS guidance. So technology is there. So the remaining technology companies are providing some positive guidance, which is far below the 5-year average. Then we got healthcare below its 5-year average, consumer discretionary and industrials also far below its 5-year average, and financials are slightly higher for the remainder, and materials are higher a little bit, and real estate also higher for this particular segment. So it really comes down to what is going to be that earnings per share for the market moving forward, and what is it going to be that earnings per share for 2023, and of course for the next several years out, because at the end of the day, the market is nothing but a multiple of earnings, right? So if earnings per share are strong and you apply, let's say, a 20-25 times multiple on that earnings, then the market can sustain these values for a longer time. But if earnings per share starts to decline and we start to come down, then of course the market will all of a sudden start to seem a bit more overexpensive at the moment. So in the fourth quarter of 2022, we did see a bit of a decline on a year-over-year basis, and there are expectations that first and second quarter we're also going to see a decline in the earnings per share for S&P 500, and that's obviously going to push the multiple a little bit higher, considering that S&P is back over 4,100. Now, that being said, a lot of it depends on whether or not we see a recession in 23 or 24. So if recession happens, of course, the probability of earnings to come down is even more. But I also do believe that there is going to be an earnings recession starting after this earnings season, after we get the updates from all these companies. And I have no doubt in my mind that the chances for us to see a earnings decline on a year-over-year basis is pretty substantial, thereby starting an earnings recession after already getting Q4 and Q1 earnings declining. So 2 consecutive quarters in decline in earnings on a year-over-year basis will pretty much start an earnings recession. So let me know your thoughts down in the comment section below. Like, from a more long-term perspective, I have no doubt that earnings are just going to be fine, that we're going to be growing, and I'm still bullish and overweight tech and believe that the long-term trajectory is still solid, but we have to pay attention to what that short-term, medium-term is going to look like with respect to earnings, and are we going to see a bit of a rejection or a pullback from the market? If so, we got to be prepared. That's exactly one of the reasons why I'm also increasing my cash exposure a little bit back up to over 20, 25, 30% levels, so I can take advantage of those deals when they present themselves. So hope you guys enjoyed this video and found it helpful. A very, very quick update on the earnings, and it doesn't look super good. We do have earnings season starting out very soon, starting with Netflix on April 18th, and of course with Tesla on April 19th. But hope you guys enjoyed this video, found it helpful. If you did, make sure to drop a like, subscribe to the channel, link to our Discord, Patreon down below. Coupon code available for the bundle, Fundamental and Tech Analysis courses, 60% off, coupon code Easter to take advantage of that. As always, happy investing. I'll see you all in the next video.